Hey, welcome everybody. We are literally I'd say about 4 classes, and then it's the end of the semester, and then we into the exam. So we're kind of going to motor through because we still have about 3 learning units to get through until the end of the semester. So we still have to get to chapter 12. Okay. So just a reminder on last week. Last week we kind of started on the revenue side of things to say how do businesses then calculate revenue, and we always said it's price times quantity, so it's kind of standard. Now we're going to go into the more costing side of how businesses calculate in terms of costs, which is very similar. I want to say similar, but it's not so intricate like accounting is. So we're going to establish or distinguish between total, average, and then marginal product and what we mean by that. And then we're also going to explain the law of diminishing marginal return. Okay, and explain the relationship between this law as well as the shapes of your total. So there's a total, average, and then marginal product curves in the short run. And we're just going to recap a reminder of the short run versus the long run. And then we'll show you exactly how to draw it. So the main thing that we're looking at here is the relationship between all of these curves. So your total, your average, and your marginal product curve. So the relationship between all of these curves, and then where the law then fits in. Okay. So just a reminder on the short run versus the long run. So remember, this is not to do with a period of time. So we're not talking about the short term versus a long term. We're talking about short run versus long run. So with the short run, there must be one product. So we're making a lot of assumptions again, as economists are always, we always make assumptions here. So the firm only produces one product here. All the units are given in terms of the inputs of that product. It's basic amounts, which means it's absolute amounts. You can divide them. Okay. The product function or the relationship between the inputs and outputs are given. They're fixed. The prices are given. So you'll see everything is very much fixed when we're making assumptions in the short run. Again, a reminder that when we're talking about short run, there must be one element that is fixed. Okay. And we said in terms of the factors of production, we tend to say it's either labor can be one of them, the size of your factory can be another one. So something in terms of the factors of production is fixed. That's basically what we're referring to when we say in the short run. But then in the long run, remember, if I say to you, labor is fixed in a particular business in the short run, we can then say, if we're looking at it in terms of the long term, you can hire more laborers, people can resign, new staff members can come in. All of those things can change in the long run. Okay. So again, we covered this, right? So now we're looking at this particular business, right? In the short run. So production schedule for cupcakes. Yeah, you can see that when I said that in the short run, you can see the size of the factory doesn't change. Okay, so we are looking at this business in terms of the short run. So we're looking at it from a context of based on the amount of laborers that this cupcake business is employing. So from zero. So remember, the size of the factory is now not going to change, right? So at zero, you're producing zero. You have no laborers, therefore you're producing nothing. Okay. Now you get one laborer. That one laborer produces 50 cupcakes. Two laborers, 130. Three laborers, 200. So what can you see here in terms of the more and more laborers you are hiring, the less they tend to produce. Can you see that? So basically what we're saying is, and it happens logically in businesses as well, the more and more laborers that a business tends to employ, right, it gets to the point of saying, is there enough work for all of these laborers? You're going to get a few people, and we're all working individuals here, so we can look at our offices and say, but this person comes in, they always late, or they just sponge off of everyone. They actually not pulling their weight. That is what we're talking about here. So we're saying the business has employed people, but is there enough work for all of these people? And in some periods in a business, yes, there is. In other periods of the business, no, there isn't. Okay, until eventually you start employing that sixth person, or the sixth person that's making cupcakes in this context, and they're actually not doing anything. Okay, and then your business starts to decline, because they can be taking smoke breaks, they can be negative, they can be all of those negative connotations to certain employees, because it happens. Not everybody's happy with everyone. Okay. But the business kind of has to get to that point of finding, I want to say the sweet spot, to say that fourth laborer that's now producing 200, we can say 20 cupcakes, right? Because that's the difference between the third laborer and the fourth laborer, is the 20. From the fourth to the fifth, there's no difference. They're not. So you're paying somebody effectively, the fifth and the sixth laborer, so 2 laborers, and they're actually not contributing towards the business. Okay. So that's what we're talking about here. And that's where the law then of diminishing marginal, they add marginal, meaning additional, returns then comes from. So it purely states that the greater the quantities of the variable factor are in a fixed factor, the productivity of the variable factor will decline. In English, what are we saying? The more laborers that you employ in a fixed context, so a fixed unit of space, size of the factory hasn't changed, the less productive people become. Okay. And that's simply put. So additionally, meaning the more and more laborers you are hiring, adding to this fixed factor, which is the space of your business, the less productive people become. Okay, because the work starts to divide. You start dividing the work. So when it fell on the one laborer, they produce 50 cupcakes. When you added the second one, it's now 130. So it's an additional 80 cupcakes that second person has brought in. Then the third one, 70. Then the fourth one, only 20. So now the work starts getting less and less the more laborers you employ. Then we're saying, okay, so now we've looked at the size of the factory being our fixed element. We're acknowledging that the laborers, okay, increase one at a time. Our total product, meaning the production of all of your laborers, okay? And then the marginal product. So the marginal product becomes for every additional employee or unit of labor that you have in your business, how much are they bringing towards the business? And that's what I was saying. If you employ 0, you get nothing. Okay, so that's clear as day. So we're basically saying that our formula, and the formula is, or the formula will be in the exam. Okay, so you will get a formula sheet in your exam, which is the change in your total product divided by the change in your unit, or in this case, it was labor. The change in your labor will always be 1. So meaning you're moving from one laborer to another. You're not suddenly going to say, hey, we're moving from 0 to 6 laborers. You're not going to do that in a business. You move from 0 to 1, 1 to 2, 2 to 3. So you can see that the change in your N, or the change in your units of labor, will always be 1. So we tend to ignore it. But the change in your total product, the production, that is what we're looking at. So we're saying if you're moving from 0 laborers to 1 laborer, the difference here in our total product is 50. So that's the change. If we move from 1 to 2, we're going to say it's the 130 minus the 50, giving us 80. If we move from 2 to 3 laborers, we're going to say it's the 200 less the 130, giving us 70. So there you can already see when we're talking about the law of diminishing marginal return. It's getting less and less for every additional laborer that you're employing, meaning the additional employees bringing in less to the business, okay, until it becomes negative. And then the average, we're saying it's average across how many laborers that you have. And obviously, for the first laborer, it will be 50 because there is only one person. And then obviously, if you're employing that second person, it's our total product being our 130 divided by 2, the amount of laborers that we have, hence the 65. Okay, so there we're looking at on average, what are our laborers bringing in compared to what they are actually bringing in. Okay. And this is now the important part. Here we want to understand, and you must be able to explain it. They love asking this question. They tend not to ask it in a longer type of question. They tend to always ask this in a multiple choice situation, and that's what always confuses the students. So we're saying, looking at the same schedule, taking your total product into account, right? If you had to graphically illustrate that, it would look like this. Okay, so remember I said to you, I think it could easily have been 2 or 3 weeks ago now, where I said to you, the type of wording that you use when you are explaining a graph becomes incredibly important now. So we're saying, if you're going from 0 laborers to, let's say, I'm not go according to where the line is, it looks like 5.5, but let's say 6 for sake of accuracy, because you can't hire half an employee. So 6 laborers, you would then say you are increasing at an increasing rate. Okay. And then once you get to about the 6th laborer, it starts to increase. It's still increasing because it's still going up, but it's increasing at a decreasing rate until it gets to about laborer number 9. If I'm looking at that correctly, laborer number 9, then it starts to decrease. Okay, so that's how you must start explaining the relationships here. Okay, so for number 1, I'm just going to change my arrow, otherwise I can't see. Oh, I should have changed the colors as well. I'll fix that in the slides. It's basically just to explain that you're increasing at an increasing rate until you get about laborer number 6. Then you start to increase at a decreasing rate, and then you start decreasing. Then your productivity, or your total product, essentially your productivity within your business, starts to decrease. Then they also look at it from a context of saying, but then what happens while our total product is increasing at an increasing rate? What is happening to our marginal product versus what is happening to our average product? So we're saying, as your total product is increasing at an increasing rate, your marginal product is greater than your, or larger than your average product. And then when your 2 curves intercept, right, your total product then starts to increase at a decreasing rate. Okay, so that's at this point, not that one. There we go, that one. Okay, so there we are, exactly in the middle. Okay, starts to increase at a decreasing rate, and then it hits its maximum point. And when it reaches its maximum point, we say that is at the point where your marginal product is negative and your average product is still positive. So it's all describing what is happening in terms of your total product in relation to your marginal product and your average product. And you must be able to express that relationship between the two. So you're literally telling me, what do you see? What is happening in your business? Is your average product positive? Is your marginal product negative? What is happening here in terms of these two curves? Or three, if you want to count the fact that the other two are collectively together. Okay. So essentially, this is what the basics of it is, where your average product increases at an increasing rate, and at that point, your marginal product is greater than your average product. At a point where your marginal product and your average product intercept with each other, your total product then starts to increase at a decreasing rate. And then when your marginal product hits negative, becomes negative, your total product starts to decrease. But so does your average product. Okay. So it's just a quick highlight of what the graph looks like rather than using the one in the textbook. This one it kind of simplifies everything for you. Okay. So we're building on this law where we're now saying the greater the quantities of a variable factor are added into this fixed factor that stood, okay, points are reached where first the marginal product, then your average product, and then finally your total product start to decrease. Okay, so now going back to the curve, they said first is your, let me just admit somebody. Okay, so first, which one starts to decline first? Which curve starts to decline first? So they're saying first it's your marginal product, then your average product. So first, marginal product hits its maximum, its highest point, starts to decline. Then your average product hits its maximum, and that's where the two intercept with each other, then starts to decline. And then finally, your total product hit its maximum and then starts to decline. Okay, so we're just building on this law the whole time, but it's basically telling me what you see, right? And then there's a video that you guys can listen to. So in terms of the table, this is on average what you should expect in the exam. Obviously not as big or not as many numbers here. 7, they usually stop at about 3 or 4. They don't go as far as 7, but for practice sake, the one that I will ask you to look at, I'll show you now. It's not this one. This all comes from the textbook, by the way, is this one. So you should expect the table to somewhat look like this, right? Where they're saying, okay, your units of labor, they're telling you it's the N number, so it's 0 to 4, and then your total product, and they're saying your average product, and then your marginal product. Now, in remembering that the formulas themselves will not be in the table, right? You'll get a formula sheet, and you must then know which formula belongs to which element. So in terms of 0, the first line is very, very, very simple, okay? Because if you're employing 0 laborers, your total product will be 0. Thus, your average product will be 0. So everything in terms of the first line is usually 0. So they're saying then your total product then becomes 14, okay, for the first laborer. So there we already know in terms of our formula. Sorry, I'm just trying to admit somebody. In terms of the formula for the average product, we're going to say it's the total product being the 14 divided by 1. So the first answer will be 14. Marginal product, we're saying, is the difference. It's the difference between our total product divided by the difference between the number of laborers. Okay, so in our case, the N, the difference will always be 1, so we ignore it. The change in our total product, we went from 0, employing 0 laborers, 0 output, and 14. So we know that the first answer will be 14. Then they're saying to us, it's our average product of 15. So our average is 15. Now we're going to have to manipulate the formula. We know what N is, right? So we know that N is 2. So now if we have our average product, 15 over there, and we have 2 there, and we now want to make the total product, the subject line. Okay, so we're going to manipulate our formula a little bit, and then we end up with 30. Okay, I should have known this was undefined. Okay, so we're going to get 30. So we're literally going to manipulate the formulas here. Okay, in terms of your marginal product, there again, if we know that our total product is then 30 and our previous total product is 14, we'll know this is 16 because it will be 30 less the 14, giving us 16. So you can manipulate the situation back and forth. Usually what I tell the students to do is leave the marginal product for last. So leave this column for last, because 10 to 1, you're going to need either this column or this column. And it's easier to get these two columns than it is to get the marginal product. But if you have enough information, go for it. You can calculate it. But you can see there's multiple ways of going about it. But this is typically what we expect in the exam. We don't expect you also to show your calculations. We just expect the answer. Okay, so at least you don't get marks or anything like that, but it will help you if you need to, right? So this is what should look like in the exam. Okay, on average, this is just using Excel. Obviously, I'm an Excel girly, so I use Excel for everything, right? So the last section of this, or almost the last section of this, we're physically going to get into the costing side of it now. And there we know that we calculate the revenue, the cost in your product, so that we kind of sort of worked out already, explaining the relationship between your different cost concepts, and there accounting comes into it quite a lot, drawing the average and marginal cost curves now. Okay, so now we're done with the total product, meaning the actual production of the business. Now we're going to look at the costing side of the business and then explaining the relationship. You can see the explain of the relationship is very important here. Okay, so back to accounting again. We know that we have fixed costs. We know that we have variable costs. That doesn't change. Okay, so even in economics, the costs that don't change according to output, i.e. your rent, it's not going to change. Okay, your variable costs, like your wages, tend to change depending on how many hours, how many laborers, all of those things tend to vary. So we do acknowledge that you have fixed costs and you have variable costs. And in totality, adding the two elements together will give us our total costs for your business. So we're looking at total fixed costs, your variable costs, as well as your average costs. Okay, so again, in the short run, there is always one element that is fixed. In this case, our one element that is fixed remains the size of the factory. Okay. Then we have our laborers, again, 1 to 6, our total product. So we know what the production is per laborer. Now we're looking at the cost side of it to say, if we have no laborers, because remember, total fixed costs don't change regardless of whether you are producing or not. That cost is still there. So if you're using rent as an example, you have a size of your factory. The rent is due every month, regardless of whether you've employed people or regardless of whether you have physically produced any good. Okay, so 2,000. So the easiest way, the fixed cost remains the same regardless of the volume of laborers that you have. So you'll have a cost of 2,000 right through to the 6th laborer. Okay. Again, in remembering that the formulas don't get added to the tables. So I usually add it in, and I tell the students when you are doing these tables, because you can see the tables getting bigger and bigger and bigger, right? We started with the size of the factory, the units of labor. So that's your total product. Remember now the average product is not here. The marginal product is not here, because now we're building on costs. So this table gets to about 7 or 8 elements long. And I tell the students, take the formula sheet, plump it just under the table so that's not a back and forth that you need to do in the exam either. Okay. So total fixed cost doesn't change. All right, so you're going to have 2,000 right to the sixth laborer. Then your total variable cost, that tends to change depending on whichever element is the variable element, whether it's wages, or yeah, wages is the best one to use. So they're saying at 0 laborers, you have 0 variable cost. Okay, if you're using wages as an element. Okay, then you have your total cost. So total cost then is made up of your fixed cost plus your variable cost. Gives us your total cost. Okay. We are also missing your average cost, but we'll get to that now. So you can see total fixed cost will be 2,000 right down. Your total variable cost dependent. So here, if we know that in terms of our third laborer, we have 2,000 as your fixed cost, plus 3,000 as your variable cost, your total cost then becomes 5,000. Very simple. So here, they gave us our total cost of 6,000, but we know that our total fixed cost is 2,000. So we will say 6,000 less 2,000 gives us 4,000. Again, total fixed cost 2,000 for the fifth laborer, plus your variable cost of 5,000 gives us our total cost of 7,000. And this is how you need to constantly be manipulating the formulas. Hence, I say to the students, write the main one down, and then you can start to manipulate depending on which variables you do and don't have, because you might not have a lot of time in the exam. Okay. There we go. That element down here. Right, so it will look like that. Then we get to our marginal cost as well as our average cost. So we're saying in terms of our average product, we want to know how much product on average are your laborers producing, depending on the volume, the number of laborers that you have. But we also want to know in terms of the costing side of it, to say on average, how much is the costing of production based on how many laborers you have. Okay. And the same with marginal. We're saying for every additional employee that you are hiring, what is the costing for that that individual? So you can have a lot of different formulas here. So in terms of the average cost, it's the average cost per unit. Okay, so we can say it's our total cost divided by a quantity or divided by N, depends. Okay, or you can say your average cost is equals to your average fixed cost plus your average variable cost. It all depends on which elements they give you in the exam. Okay, then you have your average fixed cost, to say it's the fixed cost per unit in this case, and that can be your total fixed cost divided by your quantity. Then we also have your average variable cost per unit, and that's your total variable cost divided by your quantity. So you can see if you're calculating, the easiest way to remember these formulas, if you're going to study them off by heart, if you're looking at the average cost, the formula becomes total cost divided by quantity. If you're looking at the average fixed cost, it becomes total fixed cost divided by quantity. If you're looking at the average variable cost, you're looking at your total variable cost divided by quantity. Okay, that's the easiest way I remember. And then, or you can say, if you're looking at the average cost, which is the totality of your average fixed cost and your average variable cost, then it becomes your your average fixed cost plus your average variable cost, if you have all of the elements. Okay. Then the marginal cost is the literally cost of producing one extra unit of the product, which then becomes the change in your total cost divided by the change in your quantity, in remembering that the change in your quantity will always be 1. Okay. So this is typically what it would look, what one of your tables in the exam would look like, in remembering that the total product your total product is there, but your average product and your marginal product are not there. So we can add 2 additional columns to it, but on average, this is what it would look like, right? So now they're saying they gave you quite a lot of information here, right up until your total costs. So they're saying your average fixed cost. We're saying one of the formulas can be, if you're looking at your average fixed cost, we said it's your total fixed cost divided by your quantity. Okay, that's the easiest way. Your average variable cost becomes your total variable cost divided by quantity, and then your total cost can either be your average fixed cost plus your average variable cost, which will give you your average total cost, or it can be the change. The easiest way to look at it, you can then look at your total costs divided by quantity. And this is how you then have to calculate the missing variable. So it all depends. And then the marginal becomes your change in your total cost divided by the change in your quantity. And your change in your quantity is always 1. Okay. And then you fill in the table. So literally complete the table. I plumped in all the formulas. I just ask the students to constantly rewrite the formulas, even though I know the formula is going to get given to you. It just helps. This one is a practice table. The answers are in the slides, and you can just go through that. It just becomes complicated on the last element, where the only thing that they gave to the students is the marginal cost, but this was a very difficult, I think this was one of the exam questions from way back in the day. Okay. And then the video. Then we said, we want to now know how to construct these curves. So logically, we are not going to give you the numbers to construct these curves. We just want you to understand the shape of the curve compared to, so this is the cost curve versus your average product or average product, marginal product, and your total product. So we're saying when we're looking at an average cost curve, the shape of it is always a smile. Okay, so it's U-shaped. And then when we look at your average variable cost, we know that average variable cost in terms of your average cost. So average cost is average variable cost plus total fixed cost. So we always know that it's still U-shaped, but it will always lie below our average cost curve. Okay. And then we have our average fixed cost. I'll skip that one. Oh, well, average fixed cost stays the same, but still. Okay, where we're looking at our marginal cost as well. So marginal cost, I always tell the students, looks like a Nike tick. So it always starts high, dips very low, and then rises. Okay. And then when we're looking at the relationship, we're looking at not so much the relationship between our average variable cost curve and our marginal cost curve. We're more looking at your average cost curve, this one, and our marginal cost curve. We understand that your average variable cost plus your average fixed cost make up your average cost curve. But in terms of the relationship, we say that your marginal cost curve will always cut all of your curves, all of your cost curves at their lowest point. Okay, so at their minimum point. Okay, and there's your average fixed cost, because I said it lies very low because we know that the average fixed cost will remain the same. Okay. So now if we had to put all the curves together, like I said, the main ones that we're looking at is your average cost curve, your U-shape. You have your average variable cost that will always lie below your average cost curve. Then you have your marginal cost curve that kind of looks like a Nike tick. And then your average fixed cost curve that's right at the bottom. Okay. And then there's a video to help show you. So when we're looking at a comparison now, we're looking at the comparison between our total product, which essentially means our revenue, okay, versus our cost curves. So they kind of look opposite to one another. Our total product curves are sad faces versus our cost curves that are happy faces, they're U-shaped. Okay. And that's what we're looking at. So the comparison between the two, and remembering that your marginal product hits first, then your average product, then your total product starts to decline. So they're declining differently, and that's the law of diminishing marginal return. And your marginal product curve will cut your average product curve at its highest point, okay, versus your cost curves, where we're saying your marginal cost curve will hit its lowest point first, then your variable cost, then usually your average cost curve straight after that, and your marginal cost curve will always cut at its lowest point. So when we're talking about average product, it's at its highest point. And then when we're talking about your marginal cost, we're saying it's at its lowest point, and that's comparing the two curves. Okay. In terms of the textbook, this is how they look at it. It's all about the relationship, like I said to you. Okay. The first one we're looking at, now I have to change the slides quickly. Okay, so it's all about the relationship. So we're saying your marginal product is at its highest point, it rises, okay, versus your marginal cost that decreases first, hits its lowest point, and then starts to increase, sort of like a Nike tick. Same with your marginal product. It increases quite sharply, hits its maximum, and then starts to decline. Okay. Then second part, there we're looking at now your average product curve or your variable cost curve, where those two curves hit its maximum. And you can see the marginal cost, if we're looking at the costing one, cuts it at its lowest point versus your average product curve, where your marginal product curve cuts at its highest point. And it's comparing the two, and then all the curves for marginal products start to decrease versus with costs where all of them start to increase. Okay, so it's all about the relationship between the different curves. And then in the short run and the long run in your textbook, they literally give a very short synopsis of what we're talking about when we mean fixed and variable. And in the long run, everything varies, because remember, the one fixed element usually is your rent or the size of the business or the factory, whatever you're working with. That's usually some form of a fixed element. The fixing, or if you're looking at it in terms of costing, it can be that your rent is then your fixed element. And then in the long run, everything varies, meaning your rent can vary. You can increase the size of the business. They can increase the cost of renting. Anything can vary in the long run versus the short run. Okay. So that's just a quick synopsis. And then that is it for this learning unit. So we are done for the night. Does anybody have any questions? Not. Great stuff. I am still in the process of wrapping up your marks. I'm hoping I'll get them done early next week. And then you should have your marks before the next class. So I will see you guys next week. Enjoy your week.